we are going to be looking at the IAS 33, that is earnings per share. So we are not going to be wasting time, straight forward to the point. Then we go back. Okay, so we will be looking at 33, which is earnings per share. Okay, under this one, we are going to be looking at two issues: basic earnings per share and what we call diluted earnings per share. Okay. Okay, if we are saying earnings per share, we are just saying that, okay, after the company has made a profit and they have paid return to what? To other investors, which are going to be the preference shareholders and the debenture holders and whoever is going to be investing into the company. Okay, the earnings that will be available to the owners of the company, assuming we have to spread it over the number of shares that they have purchased. Okay, each share will be taking how much? That's what we call the earnings per share. So, assuming the entity, assuming we have made a profit of, okay, let's see, earnings for the year is 20,000. Okay, and the company, the number of shares outstanding. So let's say the number of shares outstanding. Please, we said that number of shares outstanding is the number of shares in issue, not authorized shares. Authorized shares is the maximum number of shares that a company can issue. So they can give you authorized shares and they can also give you shares or outstanding shares or shares in issue. Authorized shares is the number of shares that the maximum number of shares that the entity can issue. Okay, it doesn't mean that they have issued all those shares or all those shares have been purchased by what? By the public. But what is the shares that is being purchased by the what? Uh, by the owners. That's what we call the shares outstanding or the shares in issue. It is that number of shares that they are using to generate what? The income, not the total number of shares that they have. So we use the shares outstanding or shares in issue. So let's say the shares in issue is 10,000 shares. Okay. Assuming we are distributing the 20,000 on number of shares that you have owned. Okay. Each share will be taking how much? Okay, so we'll be having 20,000 divided by what?
10,000.
Okay, that will give us 2 cedis per share. Okay, so the earnings per share is the only shareholders what ratio that has what a standard on its own. Okay, why? Because the earnings per share tell us how the shares of the company or how the market price of the company will also be what will also be moving in the future. So if the earnings per share is increasing, it is telling us that the shares of the company the share price of the company will also be what will also be increasing. Okay, so this basically the earnings per share. Okay, the basic earnings per share. Basically, the basic earning per share is calculated as the earnings attributable to, okay, earnings attributable to the ordinary shareholders divided by the number of shares that has contributed to that particular earnings for the year. Okay, earnings per share is calculated on yearly basis. It is calculated based on the what? On the contribution that the shares has made to what? To that particular earnings. So we'll be doing a lot of things. So let me just make it very simple. Weighted average number of what? Weighted average number of shares. Okay. So this is how we do it. Okay. The earnings that we are talking about over here, which earnings are we talking about? We are saying that earnings are attributable to what? To the ordinary shareholders. Okay. So the earnings is calculated as profit after tax minus what? Irredeemable uh, preference dividend. Okay, I will explain the irredeemable preference dividend. Okay, irredeemable preference dividend. If you come to IFRS 9, irredeemable preference shares are treated in the same way as what? As equity. They are treated as if they are equity instruments because they don't present any cash obligation to the entity. So they cannot be classified as a liability because the entity is not going to be paying any amount at a future date to redeem it. Okay, so their dividends are treated as what? As if it is what? Equity dividend, which will be taken to statement of changes in equity. But if we come to redeemable preference shares are presenting cash obligation or future cash obligation to the entity because the entity will be paying cash in the future to redeem them. So they are classified as what? As a financial liability. So their dividends are treated as part of the finance cost, which has been taken away from the profit already. If you are coming to do the earnings, the only thing that you have to take from the earnings is irredeemable preference what? Dividends. If you are giving redeemable preference shares, their dividends are treated as finance cost, which is already taken away from the profit. So if you are giving irredeemable preference shares, whether they are saying that dividends has been paid or dividends has not been paid, the entity will actually pay the dividend. So you accrue the dividend. So you take you calculate the dividend on it. How do you calculate it? The percentage attached to the irredeemable preference shares on the value. So you get a dividend, you take it from the earnings, the earnings that has been made for that particular year. Okay, let's come to this is for a single entity. Okay, let's come to a group entity, or we are doing this for a parent entity. Okay, so if you are doing this for a group entity, which will be the parents. Okay, so the earnings per share for the parents, this is how you are going to be doing it. Okay, the basic earnings per share for the parent entity. Basic earnings per share for the parent entity will be the earnings attributable to, okay, earnings attributable to the equity shareholders, which is a what? Which will be, you see that at the end of the day, the what? Profit of the subsidiary will be shared among the NCI and the parents. Okay, the profit of the subsidiary will be shared among the NCA and the parents. So if you are doing the what? The basic earnings per share, we are doing this for the parent company. So what is the profit that is relating to the parent company and what is their number of shares? Okay, what is the profit relating to the parent company and what is their number of shares? So we take the profits attributable to the parent company, then we divide it by their what? Their weighted average number of shares. So we'll be looking at what we call the weighted average number of shares. Okay. Why are we calling the weighted average number of shares? Okay. The earnings per share is calculated in the what? In the highest denomination of the what? Of the country's currency. What do I mean by that? If you are getting 2 cedis, okay, maintain the 2 cedis. But if you're having 0.2, okay, you change the 0.2, uh, you change the 0.2 cedi to pesos. Okay, so if you're having 0 point something, 0 point something, 0 point something, okay, if you're having 0 point something, you change it to what? You change it to pesos. But if you're having cedis already, which is 2 cedis, 3 cedis, or 1.5 cedis or something, maintain it. But if you have, let's say 0.5 cedis, you just multiply by 100 and have 50 pesos. Okay, that is what I'm saying. Okay, let's come here. Let's get into business and do this. We are saying that earnings per share is calculated for a year, is calculated on yearly basis and is calculated based on the contribution that the shares has made to the profit end. Okay, let's take this example here. Okay, let's come here. So let me say we have something here. Okay, so let's see, this is January 1, 2021. The company has, okay, their number of shares. is 10,000 shares. Okay. So let's say that in the middle, which is July 1, 2021. Okay. The company, so let's say 1,000 shares. The company made a full market issue. Okay, we call something a full market issue. A full market issue means that the entity is going to be receiving money up to the market value of what? Of the shares. So the entity made a full market issue of, okay, a full market issue of 5,000 shares. And their profit for the year, profit for this particular year, okay, profit for this particular year. So December 2021, the company made a profit attributable to those people at a value of 30,000. Okay, and they have been asked to calculate the earnings per share. And what you have done over here is this. Okay, so you have done something like the basic earnings per share. You have done something like this. Okay, you are saying that that is 30,000 divided by, let's say, 15,000 shares. This is what you have done. Okay, so you're having 2 cedi per share. Okay, if you have done something like this, okay, if you have done something like this, they will tell you that, okay, so you not get any tips for this one. They will tell you that this thing is what? Let me use red. Let me use red so that you know that it's wrong. Okay, red will tell you it's wrong. Okay, if you have done something like this is wrong. Okay, why? Why do you think the answer is wrong? It's not 2 cedis per share, but the earnings per share is not what? It's not 2 cedis per share. So what you have done over here as 30,000 divided by the what? The 15,000, which is the total number of shares. They have 1,000 at the beginning, and uh, at 1st July, that is after 6 months, they have made what? A full market issue of 5,000. So you are saying that the earnings per share is what? Is 30,000 over total number of shares at the end of the year, and you're having 2 cedis per share. And I'm saying that this is wrong. And I'm also asking, why are we saying, or do you also agree that that is wrong? And why are you saying that that is wrong?
Okay, so my response would be the 10,000 has been in existence for a year, and the 5,000 has been in existence for 6 months. So they can enjoy 1 year profit, whilst the 1,000 also enjoys uh, 1 year profit.
Okay, okay. That is perfect. We say that the earnings per share is calculated for a full year, isn't it? And it's also calculated based on the contribution that the shares have made to that particular profit. Okay, let's come here. The 10,000 over here will contribute to the what? To the profit for a full year, isn't it?
Sure.
Okay, or it will be there for a full year. But let's come here. The 5,000, will the 5,000 contribute to what? To the profit for a full year? Is it going to be 5,000 that is going to be generating or that is going to be contributing to the 30,000? No, it's going to make only 6 months contribution to what? To the profit. Okay. It's going to make what? Only 6 months contribution to the what? To the profit. Or the 5,000 has been there for only 6 months. So we cannot what? We cannot make the full 5,000 available for what? For distribution. No. So what we do over here is, so this is what we are calling the weighted average number of shares. So what we do is over here is that if 5,000 is for full year, then 6 months will be what? So we come here, we have our existing shares. Okay, we have our existing shares. So with this one, we'll be doing it. The existing shares of 10,000 will be having a full year contribution, isn't it? Will be there for full year. So that will be 12 over 12. The I'll be getting 10,000 over there. Okay. Let's come to the full market issue. Okay. The full market issue will be from July to what? December. Okay. And that will be having only 6 months contribution, or that will be there for 6 months. We calculate earnings per share for a full year. Okay. So that will be from January to what? To December. Okay. We have 10,000 shares from January to December. So that has made a full year contribution to the profit. But we have a shares from what? From July to what? To December. So it means that we have uh, operated for what? For 6 months before issuing this. So this particular shares will only contribute to the profit for 6 months. It will be in issue for 6 months. So what we have to do is that what will be the 6 month out of that? So we have the 5,000 multiplied by 6 over 12. I'm having 2,500. So my weighted average number of shares is 12,500. Okay, let's come to alternative way of calculating the weighted average number of shares. So the weighted average number of shares, this is how you do it. Okay, so what you do over here is that you are going to be separating the profit into two, the first 6 months and then the last 6 months. Okay, so the first 6 months, let's come here. Let me have January to June. Okay, the first 6 months. What is the number of shares that were there? Okay, 10,000. Only 10,000 was there from the beginning to June, isn't it? Okay,
Sure.
so that will make a 6 month contribution to that 6 over 12. What are we having? We'll be having 5,000. Okay, so let's come to July to December. July to December, the 10,000 will still be there for 6 months plus what? Plus this one. So the profit for July to December, it will now be two category of shares that will be contributing to that. And that will be the shares that we have from the beginning will still be used for the 6 months or will still be in issue for the 6 months. Then we also have the 5,000, which will also be which will also be in issue for the 6 months. So we now have total number of shares to be 15,000. Okay, multiplied by 6 over 12. So we'll be having 7,500. If you put all of them together, you have 12,500. Okay. But this particular one that we are doing 6 months, 6 months, please, if you don't take time, it will over you. So you just have to say that, okay, the existing shares will be there for what? For 12 months. So just do the existing shares separately. The 5,000 will be there for only 6 months. So it will make only 6 months contribution. Or since we are calculating the earnings per share for a full year, we cannot take the 5,000 because the 5,000 has not been there from the beginning of the year. Okay. So our basic earnings per share now will be what we call the 30,000, okay, divided by what we call the 12,500 shares. Okay, what will be the answer now?
$2.4.
Okay, that will be 2.4 Ghana cedis per share. Okay, so this is what we call the full market issue. So the earnings is basically the profit for the year divided by the shares at the beginning of the year or the full number of shares. But what is going to happen is that the entity they are operating, so at a point in time, they will now be issuing shares. Okay, they will now be issuing shares. They want to increase their operations. So at a point in time, or maybe within the year, they will issue number of shares. You can't use that total number of shares to add it to your shares to determine the earnings per share. No, the earnings per share is determined on yearly basis, and it will only be what the only share that we can use is the shares at the beginning. That share is going to be there for a full year. But this 5,000 will be there for only 6 months. So we cannot use all the 5,000. We only find 6 months of that, or that particular one will make contribution to only 6 month profit. So we determine that particular one. So that is how we go about a full market. So the basic earnings per share, we'll be having issues with what we call the full market issue, full market price issue, where at within the year the entity is going to be issuing what new shares. That is going to be increasing their shares. And that is an example that we have done over there. Okay, let's pick, let me pick the first tutorial question there. Okay, question number one. Let's finish that one. Then we go to what we call the bonus issue and right issue. Then we go and come back tomorrow for diluted earnings per share. Okay, question number one. Who is reading for us?
Question 1.
Okay.
A Limited has earnings of 300,000 cedis during the year ended 31st December 2016. On 1st January 2016, A had share capital of 100,000, one Ghana cedi share. On 1st March 2016, a further 60,000 shares were issued at 3 cedis 25 pesos per share. Calculate the basic earnings per share.
Okay. So the earnings. Okay. Okay. So let's do our simple thing here. Okay. So January 1. What is the number of shares available? What are the shares they have in issue? The shares at the beginning of the year.
100,000.
Okay. So that will be 100,000. Okay. So they have 100,000 shares. They have 100,000 shares. Okay. So when was the full market issue made? Okay. When are they issuing the new shares?
1st March.
Okay. So we have first March. First March. We have first March there. So let's come here and see 1 March. Additional shares of what?
60,000.
60,000 have been issued. Okay. So this will be 31 December. Okay. So the profit for the earnings for the year is what? The company earnings was
300,000.
300,000.
okay. So we have to determine our basic earnings per share now. So we have basic earnings per share is equal to the earnings attributable to the earnings attributable to the ordinary shareholders, okay, divided by the ordinary shareholders that has been in issue or that has been there for the full year, the ordinary shares that has been there for full year, or the ordinary shares that has contributed to the profit of what 300,000. We are getting the profit for 300,000, which is from the beginning to the end. So what is the number of shares? What is the actual number of shares that has been in there or that has generated a profit of the 300,000? Okay, so we have to determine our number of shares now. Please don't say that the number of shares will be 160,000. No, the 60,000 has not been there for full year, so it has not contributed to the profit for full year. We have operated for 2 months before issuing that share. Okay, so it will be only the 10,000 that will be there. So you have the existing shares. Okay, we have the existing shares. The existing shares will be there for full year, isn't it?
Yes, please.
So we have 10,000 multiplied by 12. You can do it by one. We are going to be having 100,000 shares. Okay, then you come to the market issue or the full market issue. That will be there from March to what?
To December.
Okay. So that will be only 10 months. It will make a 10 months contribution to the profit. So 60,000 multiplied by 10 over what? 12. What are we having?
50,000.
We are having 50,000. So total will give us 150,000, isn't it?
Yes, sir.
Yes, please.
Okay. So you can also, for me, you use this one. Use the one that we are doing over here. Okay. Tackle each of the shares separately. Okay. But if you like this one too, you can also move on. So we can see that before the market issue, 10,000 has been there for 2 months, January and February, isn't it? Okay.
Yes, please.
So we do the January and February first, January to February first. Okay, that will be only the existing shares. That will be used to generate profit for 2 months. So multiply by 2 over 12. What are we having? So January, February, it will be only 10,000 that we are going to be using to generate profits. Okay, so that will generate profit for only 2 months. Okay, I'm having 16666.7.
Yes.
Okay, so 16666. Okay, let's just make it 16667. Okay,
Okay.
so the six are
The 6 is 3, then 7.
okay. Let's come here. Okay, so we are just sharing the profit. The meaning is that we are sharing the profit. So what was the profit end before we issue? And what is the profit end after the issue now? Okay, so this will now be 160,000. Okay, so from March to December, we are going to be having the 100,000 that we have at the beginning plus a new issue. So what is the shares that end that particular profit? That will be 10 over
What?
12. What are we having as the answer?
133,333.
Okay, so 1, 3, 3, 3, and another 3, isn't it?
Yes.
Okay, so that will still give you what?
150,000.
Okay, so we are having 300,000. Okay, 300,000 divided by what? 150,000 what? Shares. What is the answer that we are having?
2.
Okay, 2 cedi per share. Okay, so if we say basic earnings per share, we are talking about the earnings per share on the shares in what? In issue. Okay, the earnings per share on the what? The actual, okay, let me just say the actual earnings per share. Okay, so what is our shares at the end of the year and what is our earnings? That's what we call the basic earnings per share. But if you come to diluted, what we are saying that, okay, do we have any instruments in issue now, or do you have any instrument now that will later be converted into what? Into shares, and what will be the impact of that on our current earnings per share? So that is what we do over there. So let's come to this one. So the first one is a full market issue. Full market issue means that the entity is going to be issuing the shares at the what? At the current what? Share price. So we are going to receive the money that we're supposed to receive. Okay. Entity can also what? They also like to increase their number of shares using what we call bonus issue. So if you count to bonus issue, the entity can also increase their existing shares by doing what we call a bonus issue. Okay, bonus issue does not bring what? Cash. Okay, bonus issue does not what? Bonus issue does not, okay, no cash, no cash is what is generated. So bonus issue does not come with any what? Any cash. Okay, it is only the full market issue that we do it like this. So this one we are issuing it at what? At a full market. So the people will become owners from the time that the shares has been given to them or the time that they have purchased the shares. Okay, let's come to this what we call the bonus issue. Let's come here. Let's come here. Let's assume that. Let's come here. Let's assume that. Let's assume that the entity. Okay, the entity is having. Okay, so let's assume that the existing shares. Okay, the existing shares of the entity. Okay, so let's say that the existing shares of the existing shares of the entity is 100,000 shares. Okay, 100,000. Okay, so that was, let's say that was January 1. Okay, let's say that July, so the entity has made a bonus issue, which let's say it's 100% bonus issue. So the entity has made 100% bonus issue. 100% bonus issue is 1-for-1. So if you have one share, you'll be taking additional share for one. Okay, bonus issue or what we call a scrip issue. So you can have what we call a scrip issue or what we call the bonus issue. Okay, so let's come here. There was a bonus issue of, there was a 100% bonus issue. Okay, the market price of the market price of the entity, let's say is 10 cedis. Okay. Okay. So what we do is that let's find the market value or what they call the market capitalization rate of the entity. So let's find the market value of the entity before the right issue. Okay. Before the right issue, I say before the right issue, before the bonus issue, okay, before the bonus issue, the entity was having 100,000 shares valued at what? Value at,
Thanks.
okay,
That is 10 city.
and that will give us 1 million, isn't it?
Yeah.
Yeah.
Okay, that will give us 1 million. Okay, so we have 1 million there. Let's count to after. Bonus issue is not bringing any cash, isn't it? Okay.
Yes.
So since the bonus issue is not bringing any cash on the stock exchange market, the value of the shares of the company will still be what? Will still be the 1 million, isn't it? Okay.
Yeah.
But this is what will happen. The bonus issue is 100%. 100% means is that 1-for-1. So our number of shares will now be 200,000. Is that correct?
Yes, please.
Okay. What will be the share price now?
50%.
No,
No,
it's not.
5 cedis, sorry.
That will be
5 cedis.
5 cedi. Okay. Then we will still be having the 1 million, isn't it? We still be
Yeah.
having the 1 million, isn't it? The bonus issue does
Yeah.
not come with any cash. Okay, let's come here. Let's come to, let's see, we have okay, we have a shareholder whose name is what? Let's say Sam. Okay, Sam is having, let's see, 5,000 shares. Okay, let's calculate the value of Sam. Okay, the shareholder's worth or the value of Sam in the company. So we let's have before and after. So before, Sam will be having 5,000 at
10.
5,000 at 10 cedi. Okay, 5,000 at 10 cedi. Then we have what we call the 50,000, isn't it?
Yes.
Okay. After what we have over here is some will now be having 10,000 shares, but this will now be at what? 5 cedi.
I see this.
Okay. So, okay. Okay. You can see that the Sam's worth is what? It's still 50,000, isn't it? Okay. You see, if you come to the bonus issue, the bonus issue is just like, okay, you have 20 cedi notes. Okay, you have 20 cedi notes. And someone has asked you that bring the 20 cedi notes, and the person will now give you 1 cedi note for 1 cedi note or 21 cedi notes. Okay. So you have 20 cedi notes, and the person is saying that, okay, you bring that one. We are going to be increasing it for you. So what we'll do is that the person will take the 20 cedi notes and now give you 21 cedi what? Notes. Okay, that is about the bonus issue. The bonus issue does not bring what? Any shares. But the beginning of the person's value is the same as what? The value at the end. Okay. So for this one, we can say that okay, the value is still what? Is still the same from the beginning to the end. Okay. So we can say that the bonus issue over here, or we can also say that this is actually the what? The beginning value of the person. Okay, because 50,000, 50,000 bonus issue does not bring what? Does not bring additional cash. So we don't do time apportion for what? For the bonus issue, because it is not bringing cash. It will not have effect. If it should be a full market value, we say that this is going to be having effect, or they will become owners of the company from the time that they have paid for the shares. But this one is the existing shares that we are giving these to. So it means that this thing has been given to them from the beginning of the year. Okay, so bonus issue. So the bonus issue is assumed to be in existence from the beginning of the year. Okay, it doesn't matter when it has been made. So if the bonus issue is made on, let's say, October 1, okay, the bonus issue is made on October 1, 2021. No, we don't do that. The bonus issue is going to be having what? Effect for only 3 months. No, the bonus issue is not bringing money. We do this for only what? Only shares that are bringing money. The shareholders will become owners from the time that they have paid for the shares. But the bonus issue, we are giving it to the existing shares, the existing shareholders. Okay, so we assume that the bonus issue over here is also in existence because this will be made on shares from the beginning of the year. So they have also been existent from the January to December. So we don't what? We don't do that 3/12 by this one. However, in the bonus issue, there can be a multiple issue here. There can be a multiple issue here. Okay, there can be a multiple issue here. The bonus issue is not bringing money. Okay, so the market value of the company shares is still 1 million. So if the shares has been done, or if you have double your shares, the value that you are going to be having on the stock exchange market will still be 1 million. Okay, so now the existing shares is 200,000. Okay, how do we get the 1 million? Because the bonus issue is not bringing cash. So since we are doubling this one, it means that since we are now doubling this one, it means that we also have to double this one to get the 10 cedi. So that's how we have the 5 cedi there. Okay, that's how we get the 5 cedis. So the 5 cedi will also be splitted. Bonus issue is just like what we call share split. Okay. The shares, you have 100,000 shares and you have 10 cedis. They are valued at 10 cedis. On the stock exchange market, the value of your shares will be 1 million. If you do a bonus issue, the bonus issue is not going to be bringing what? It's not going to be bringing cash. So your value of the shares on the stock exchange market will still be 1 million. But now your number of shares is 200,000. So how do we get 200,000? How do we get the 1 million if the number of shares is 200,000? So it means that the share price will also be splitted into 2. So 200,000 multiplied by 5. That will give us 1 million. Okay. So that is what we call, it is just like the share split. Okay. So I'm saying that the bonus issue the bonus issue, it doesn't, if it is for the current year and the bonus issue, the only issue that has been made is bonus issue. Okay, whether it has been made on 1st October or not, it is assumed to be there from the beginning. Okay. However, if the bonus issue is followed or if the bonus issue is made after the market what a market issue, then there will be a different situation there. Okay, so let me come here. Assuming on on March 1, we have made a full market issue of, let's see, we have made a full market issue of, let's see, 20,000. Okay, and on October 1, we have made a bonus issue of, let's say, 142. Okay, so the bonus issue over here will be having effect on all those shares that were in existing before the bonus issue. So what will happen is that the bonus issue will have effect on the shares at the beginning, which is going to be January to December. Okay, and the bonus issue also now have effect on what? On this one, on the 20,000, because the 20,000 has been issued before the bonus issue. So the bonus issue will be having effect on this one, but this will have only 10 months effect. So this year's the 20,000 has not been there at the beginning, so that will be March to December. So in this case, what you do over here is that you have to prorata this one 10/12. Okay, but if no market value has been made, but the bonus issue, it is only the bonus issue that has been made for the year, we only calculate the bonus issue on the full basis for that particular year. So what I'm saying is a mixed combination where there can be a market issue before the bonus issue, or there can be a bonus issue followed by the market issue. They can do those particular ones, and that will be the typical question that you are going to be meeting in the exam hall. Let's come here. Okay. Let's come to this particular one. Yeah, Fred, your hand is up.
I just want to find out, why are we not using the value of the shares to share the earnings? Because if you flip back to the question that we solved, the tutorial question, if you look at the existing shares,
Yeah.
the value would have been 100,000 times 1 CD. But then the one that we issued mid-year was 60,000 times, I think, 3 point something.
1 CD is a par value. Okay. The time that you are registering the shares, you are registering the company, you have added 1 CD. That is not the market value of the share. So 1
Okay.
CD over there is a nominal value. Okay. It's a
Okay.
nominal value, but your shares are trading at 3.25, and that is the market price. So forget about the 1 CD or the 50% that they'll be adding. That is a nominal value. Okay. The time that you are going to register your company, you are going to be registering shares with what? With the registrar general department, and you have to add a value. So that is a par value, or that is a nominal value, just a value that is being attached to the shares at the time of registration. But on the stock exchange market, that is not the value of what? Of your shares. Okay, so the 3.25 is the market value of the shares. That is the market value of the shares. But if you are doing it, what you are going to be doing is that your shares is 1 CD. So you'll be having a share premium or something there. Okay. But that does not mean that you have to use 1 CD. 1 CD is a nominal value. Okay.
Okay.
Let's
Thank
come
you.
to the bonus issue. I wanted to say something. So the bonus issue, they will be giving you certain English. They can be saying that 142. Okay. They will be saying that we have 142. The company made a bonus issue of 142, 245. Okay. 145 or 144. Okay. What it means is that bring 2 of your existing shares for 1 new share. Okay. If you are a shareholder and you have what? You have 5 shares, we will give you 2. If you're a shareholder, you have what? 2 shares, we'll give you 1 new share. Okay. This is going to be calculated like this. We have 142 is the same as doing what we call 50% issue. How do we call it 50%? So We know that if you have 2 shares, we give you only half of that. Okay, if you have 2 shares, we'll give you half of that. So 1 for 2. Bring 2 shares for 1. So we are giving you half of the shares that you own, which is 50%, which is calculated as 1/2 multiplied by what we call the 100, and that will give us 50%. Okay, let's come here. This one we are doing what? The first one we are doing 100% what? We are doing 100% issue, isn't it?
1
Okay.
for 1.
It means that our existing shares, which is already 100%, will now be increased. So we add 100% to it. So it means that our total number of shares will now be 200% of the existing shares, isn't it? So 200% of what? So we have 200% of our 100,000 shares. That is the meaning. So if you want to find your shares after the bonus issue, it will be 200% of what? Of the existing shares that you have over here. Okay, let's come to this one. 2 for 5. What will be the percentage?
40%.
Okay, so that will be 40%. Okay, 1 for 5 is what?
20%.
Okay, and 1 for 4 is what?
25.
Okay, okay, let's come here. So let's say we have 10,000 shares. Okay, we have 10,000 shares, and they are saying that bonus issue of 1 for 2 is made. What will be our total number of shares after the bonus issue? It will be the existing shares. Okay, we have the existing shares of 10,000. Then we have the bonus issue. The bonus issue will be given what? How many shares will be made?
5,000.
5,000.
Okay, that will now give us what?
5,000.
Okay, so we have 15,000 in all, isn't it?
Yes.
Okay, this is what you are going to be doing. Okay, a very simple one. This is what you are going to be doing. Okay, so let's come here. Can we say that our 15,000 over here is the same as 100% of our existing share plus 50% of the existing share?
Yes.
Okay, so what are we going to be having here? Can we say that our 15,000 is 150% of the existing shares?
Yes, sir.
Okay, so of the existing shares. Okay,
That
so what
was
do you have?
15.
Okay, so that will be 50% is what? Is 1.5, or 15, or 50% is 150 over 100, isn't it?
Yes.
Okay, so 50 will go here how many times? 3. 50 will go here 2. So we can say that this is 3 over 2 multiplied by what? Multiplied by 10,000 shares. Is that correct?
Yes, sir.
Okay.
Yes, please.
What I want to say is that mostly you'll be using what we call the bonus issue fraction. Okay, so the bonus issue fraction. How do we get a bonus issue fraction? We know that we are having, okay, let me take this one off here. Okay, this one, if we want to do this for, okay, this 15,000 that we are getting over there is actually 100%. But the 100%, if you find it as a number, it will be 1. 100 over 100 is 1. Okay, 50% will give us 1 over 2. So this is how we do it. The 100% of the existing shares plus half of the existing shares, and that will give you 3 over 2. Okay. If you like, you can find the 1 over 2 and add it to the existing shares, but that's going to be wasting your time. Just find a bonus fraction. How do we get it? 1 plus what? Plus that one that we are having, or 100% plus 50%. If you are doing 40% also, this will be like this. The 40% will be like this. Your shares after the bonus issue will be 100% of the existing shares plus 40%. Okay, I hope we agree to that. And that will give us
Yes.
140 divided by 100.
Okay.
Okay, so this one, 20 will go here, 7. 20 will go here, what? 5. So you can just do 7 over 5 multiplied by your existing shares, which is 10,000 there, and that will give you the total number of shares. So we have 14,000. Is that correct?
Yes, sir.
Yes, sir.
Okay. So we will be using the bonus issue fraction. Why do we say bonus issue fraction? Because they will be giving you shares that has been, or they will be giving you some information relating to the previous earnings per share. Okay. Let me just put some illustration here. Then we move on. Okay. So let's come here. The entity is having, so let's say this is 2021 year. Okay. The entity is having, so let's see the January 1, the entity is having 10,000 number of shares. Okay. So let's say that December 1. Okay, no issue has been made. No, so December 2021, we are having profit of let's say 200,000. Okay. No market value issue has been made. No market value issue has been made, and no bonus issue has been made. Okay. But if you come to, so let's come here. What will be our earnings per share over here? The basic earnings per share over here will just be the 200,000 divided by the 100,000, isn't it? And we have 2 cedis per share. Okay. Let's come to 2022 year. Okay. If we come to the 2022 year, let's look at what happened there. So 2022 year. Okay. The entity, January 1. Okay. The entity had 100,000 shares there. But let's see, on October 1, the entity made a bonus issue. So let's come to bonus issue. Bonus issue of, let's see, 145. Okay. And the profit for this year, was actually 250,000. Okay. So they are asking you to calculate the earnings per share. Okay. The earnings per share with what? With a comparative. So why do we show the comparative? We are saying that the earnings per share of the entity talks about what? The effect, or the earnings per share is talking about how the share price of the entity will be increasing in the future, or the earnings per share talks about is somehow related to the market price of the shares. Okay, let's come here. Let's come to 2022 here. Okay, the 2022 here, our basic earnings per share will be calculated as the 250,000 divided by, let's come to the weighted average number of shares. Okay, let's count to the weighted average number of shares, and we going to be having existing shares. The existing shares is going to be 100,000. That will be a full year, isn't it? Okay.
Yeah.
But a bonus issue, we don't time apportion the bonus issue. So we assume that the bonus issue has also been there from the beginning of the year. So what you are going to be doing over here is that just find the bonus issue fraction. Okay. The bonus issue fraction, would that be 6/5? We are going to be having 100% plus 20%. Would that be 6/5?
Yes.
Okay. So we have 6/5 multiplied by the shares that we
Senior,
have over there. Yes, please.
I beg you, the bonus issue, this one, the 6/5, I beg you. Take it again for me. Let me understand it very well.
I want to look at who is talking. Who is that talking?
Me,
You. What is your name?
not.
Nat. You are you the one increasing the CIT fees?
Oh, Ebe, this one, where is it here you are coming to say all these things? Is it here we are coming to talk about this?
I want to know so that I will know the kind of explanation that I'll give to you. Because if I'm coming to register, you will not give me discount. So why would I also give you discount in the explanation? Okay. So the one for 5, let me go there and let me come to 1 for 5. Okay, let me take this one off here. Okay. Okay, the 1 for 5 is based on the shares that we have. So we have 1/5 multiplied by the shares. Okay, that will give us, I'm sure that will give us 20,000, isn't it?
Yeah.
Okay, this 20,000 will be added to, so our shares will be increasing by 20,000.
Oh, okay.
We now
That's
add
fine.
this one, then we have 120,000.
120. Okay, that's
Okay.
fine. That's fine.
Are you okay now?
Yeah, it's okay. It's okay.
Okay. Okay. So let's come to this one. So this one we normally use the fraction, okay, because they will be asking you for comparative figures. Okay, let's come here. What will be our total number of shares over here? Okay, this will be 120,000, isn't it?
Yes, please.
Okay. So that will be give us 120,000. Okay. This one, the existing shares is going to have a full year. Bonus issue is also going to have a full year because the bonus issue doesn't matter when it is what it is being made. It is assumed to be there at the beginning of the what of the year, or it has assumed to be there at the beginning or at the time that these particular shareholders become what owners of the entity. Okay. So what we do over here is that we are going to be having 120,000. Okay, 120,000 shares over here. Okay, and that will give us what? I'm having 2.08.
Yes, please.
Okay, 2.08 per share. Okay, 2.08 per share. Okay, let's do this one like this. Let me do this one like this so that I can be able to. So let me assume that the profit is still 200,000. Okay, so that we can actually demonstrate whatever I want to demonstrate over here. So the profit is still 200,000. What will be the
It's 1.66.
okay 1.66. Okay, 1.
67.
Okay,
67.
1.67 per share. Okay. Okay. The question is a shareholder will be asking you why we are still having the same number of shares. Okay. We are still having 100,000. No new issues has been made. No new issue has been made for the year. No new issue has been made for the year. Okay, you can see that the shares is still 100,000, which is the existing shares. We haven't made any full market shares. Okay, and the earnings for that particular year was 2 cedis. Why the earnings is still 200,000, and now the earnings per share is now what? It's now having 1.67. Okay, the shareholders might be thinking that the market or the company is underperforming, so they want to take their investment elsewhere. Okay, what you have to tell them is this one. Okay, so someone will be saying that why the earnings is 200,000, the shares was 100,000, the earnings per share was what 2 cedis. In the following year, no new issue has been made, no new full market value has been made, but our earnings per share is now 1.67. Okay, someone will be thinking that the company is underperforming. Okay, the company is underperforming, so we want to take our investment to somewhere. So what we do over here is that you have to show the impact of the bonus issue on the what? On the earnings per share calculated before the bonus issue. So that the people will not know that okay, the company is not underperforming, but it's because of the bonus issue that is why what the earnings per share is reducing. So what we do is that we assume that the bonus issue is also going to be having effect on the 2021. Okay, because if you don't show the comparative figure, the shareholders will be thinking that the company is underperforming. Because why will you have 100,000 and the earnings per share is 2 cedis per share, and the same year you are still having 100,000? No new shares has been what has been issued. If you say new shares has been issued, it means that we are having new shareholders now. We are not having any addition of shareholders. So why is it that we're having 200,000 and the earnings per share is now 1.67? We now tell them that we have made a bonus issue. That is why our number of shares is now increasing. So for us to be able to avoid that particular explanation, we will come and restate what we call the previous earnings per share, so that they will not be saying that, okay, why we don't have new shareholders and we are now having this and this. We tell them the effect is because of the bonus issue. So what we do over here is that we have to come and recalculate this. So we have the 200,000, okay, the 200,000 divided by the 120,000. Then we have the 1.67, okay. The good part or the funny part is that they will not give you the profit for the previous year. They will not give it to you. They will only give you the earnings per share calculated. So how do we do this? We see that this is now increasing by 6. So what we'll do over here is that we reciprocate this one. Okay, what we mean is that we turn it upside down. 5 will come to the top, 6 will come to the down. Then we multiply it by the earnings per share for the previous year. So this is what we are going to be doing over here. So let's have the comparative earnings per share, which is for that year, and that will be 2021. So we'll be having 2 cedi multiplied by 5/6. I'm sure you'll be having 1.67 also.
Yes, it is.
Okay. So you have the 1.67. So what you do is that whenever you are doing the bonus issue and you are giving previous figures, you have to restate that. You have to look at, or you have to incorporate the impact of the bonus issue on that one, so that the shareholders will not be thinking that the company is underperforming. No, they are not underperforming. I've seen 2 hands up. I'm sure the first one. Okay. Yeah, Senior Fred, is it the old one or new one? Senior Nat, is it the old one or the new one? Okay. Senior Nat, is it the old hand or the new one? Okay.
I think it's an old one. Sorry.
Okay. You and I, we are not in good terms, so you have to be very careful. Okay. Okay, so let's pick a question there. Then we do what we call a right issue. We pick a question that will be involving all of them. That is why we are going to be having the problem. Question number 2. Auntie Vic, are you gone or you are there?
I'm here. Please, which question am I reading? 2 or 3?
This early morning, what are you thinking about? Question number 2.
Hey. Question 2. At 1st April 2015, D Limited had 7 million 1 Ghana cedi ordinary shares in issue. It made a bonus issue of 1 share for every 7 held on 31st August 2015. Its earnings for the year were 1,150,000 cedis. D Limited's earning per share for the year ended at 1st March 2015 was 10.7 Ghana pesos. Calculate the EPS for the year ended at 1st March 2016, together with the comparative EPS for 2015 that will be presented in the 2016 account.
Okay, so the company had what? The company had 7 million shares at the beginning of the year. Okay, and they made a bonus issue of what? 147.
147.
Okay, on 31 August 2015. It doesn't matter, since it's only the bonus issue that is being made. We don't do that August nothing. Okay, it's not bringing cash. Okay, so it's not bringing cash, so we don't do anything to that. Let's come to 2016 here. Okay, so our basic earnings per share will give us the earnings over the weighted average number of shares. So let's come to the earnings. What is the earnings there?
1150.
Okay, 115.
0,000.
Okay. So we have to come and calculate our weighted average number of shares. Okay. So this one we can also do it like this. So we have our existing shares. Our existing shares to be 7 million, isn't it?
Yes.
Multiplied by 12 over 12. We are going to be having 7 million. So you can actually do the bonus issue also separately, or you can just put the two together. So we have the bonus issue will be 1 over 7 multiplied by 7 million. And that will also do 12 over 12. Okay. So that will give us 1 million now.
1 million.
Okay. And that will give us 8 million. Okay. Or someone can do this weighted average number of shares like this. So you just do your existing shares. The bonus issue is made on the existing shares. So what we do over here is that we have 8 over 7. Would the bonus fraction be 8 over 7?
Yes, please.
Yes, it was.
Okay. Multiplied by 7 million. That will give us 8
We are
million.
getting it.
Okay. So you do 12 over 12 here. Okay. So let's come here. This will give us 8 million. 8 million shares. Okay, what are we having as the answer?
I'm getting 0.14.
Okay. Okay. Oh, this should be 50,000. 0.14. Okay. Okay. But we said something about that. Okay. So what do you do? We say that this one should be done in the highest what? Denomination. So what you do over here is that you change it to pesos. Okay. So you have 14.3, 14 point what? 14.4. Will that give us 14.4 pesos?
Yes.
Okay. So
Yes.
14.4 pesos per share. If you're having 0 point something something, you change it to what? To pesos now. Okay. It should not be in decimals. It should not be 0.0, no. But it can be 7.5 pesos or it can be 7.5 cities. Okay. But it should not be 0 something, no. Okay, let's come here. They are saying that we should show the comparative. Okay. The comparative that will be earnings per share for. So we have the basic earnings per share, the restated one. The restated one for 2015. Okay. What is the earnings per share given to us there? 2015 is 10.7 pesos. Okay. 10.7 pesos. So we have 10.7 pesos. So you have to restate this one. That will give us 7 over 8. So the right issue fraction, which is 8 over 7, you change it down. So what are you going to be having?
9.36.
Okay. So we have 9 points. Okay, that will also give us 9.4 pesos per share. Okay. This one, you can do this one also in a different way, but let's just maintain it like this. Okay. You can actually determine the earnings for the 2015 year and divide it by 8 million, but that is not a problem over here. So this is how we go about the bonus issue. Okay. The next thing that can increase our existing shares is what we call a right issue. Okay. So the right issue is the what? Is the shares, okay, it's a new shares issued to the existing shareholders in the ratio of their proportion. What will happen with the right issue is that right issue will always be done at what? At a discount. Okay, what we are saying is that the right issue will always be issued. The shares will always be issued at a value lower than what? Than the market value. Okay, it will always be issued at a value lower than a market value. So what it means is that the right issue comes with a bonus issue. Okay, the right issue has what we call the bonus issue element and also have what we call the market value element. Okay, so the question can tell us that, okay, the question can tell us that the company is having, so let's see, January 1, the company is having 10,000 shares. Okay, 10,000 shares. Then they will tell you that January 1, they have made a right issue of what? Of let's say 144 at a market at a price of let's say 2 cedi 50 pesos. Okay, and the question will tell you that the market value before the right issue, the market value before the right issue is 3 cedis. Okay, they will tell you the market value immediately before the right issue, the market price of the shares immediately before the right issue is let's say 3 cedis. Okay, so you can see that the right issue is done at a value which is what? Which is lower than the full market value. So if it should be a full market value, it should be at 3 cedis. So we know that we are not having any bonus element over here. But the market value is 3 cedis. We are issuing at what? 2.5. That's a discount of 50 pesos. So it means that there will be a bonus element and also a full market element. Okay, the full market element will be relating to the market price and the bonus element will be relating to this one. Okay, what we do over here is what we do.
Hello, sir.
Is someone talking?
Yeah. Good morning, sir.
Yes, please.
Please, so how did you arrive at the 115, the earning per the earning for the way the 115?
The earnings is given in the question. Question number 2, we have the earnings in the question already.
Okay. Okay.
Okay.
Thank you.
So let's come to okay. So this is bonus. This is a right issue. So the right issue, we are going to be having a full market value portion and also the bonus issue. So what we do is that we want to separate the portion that is a bonus issue and the portion that is what? That is a full market issue. Okay. So this is what we do. What we do is that we determine the value of the what? We determine the value of the entity shares after the right issue. So what would be the what? What would be the value of the what? Of the entity shares after the right issue? Okay. So that's what we do. Let's come here. How do we determine that? We come to a very simple exercise. So let's come here. So let's determine the new market value of the entity now. So the new market value of the entity. So we determine what will be the value of the entity shares after the right issue. This is what we do. Okay. The existing shares that we have. Existing shares that we have is 100,000, isn't it? Okay. 100,000 at what? 3 cedi. What will be the total that will be given to us?
300,000.
Okay. That will give us 300,000. Okay. Then let's come to the right issue. What will be the money that we are going to be receiving from the right issue? That will be, it's 144, isn't it? So what will be the shares? What will be the total number of shares that will be issued to the right issue? 144.
25,000.
Okay, so we have 25,000 at what? 2 cedi 50 pesos, isn't it? What are you having?
62,500.
50.
62,500.
Okay, 62500. Okay. After the right issue, our total value of the shares will be what? 362,500, isn't it?
Yes.
Okay. And the total number of shares will be 125,000. Okay.
Um,
One
Sir,
twenty. Yes, please.
I think it's within 12.5 instead of 2.5.
No, that is a Ghana city sign there. Okay.
Ghana cedis. Okay.
Okay. So we have 2.5. Okay. So what are we having? After the right issue, we are going to be having 362,500, and the number of shares will give us 125,000. So what will be the market price per share after the right issue?
Dividing 362,500 by the beginning with 2.9.
Okay, so we have the theoretical actual price, which we call the value of the shares after the right issue. So we have 362,500, and this is on what? 125,000. So the answer is what?
2.9.
2 points.
9.
Okay. So we have 2.9 here. Okay. So our share price would have been 2.9. So even if we don't want to do anything, we should be issuing the shares at what? At 2.9. But the shares has been issued at what? The right issue should have been done at 2.9. Okay, so that we'll be having the same effect. But this has been issued at 2.5. What is happening there?
Is that a bonus issue?
There was a bonus issue of 0.4. Is that correct?
Yes, sir.
Okay. And the full market value is 2.5. Okay, so this is how we do. We come to how to share this one. But how do we calculate the theoretical expiry price? The question will not give you these things. Okay, let me show you this one. Let's come here. Can we say that our theoretical expiry price is calculated as, let's come here. Okay. Okay. Can we say that this is the same as, okay, this is the same as 1 multiplied by 100,000, 1 multiplied by 100,000, then 1 multiplied by 100,000, okay, 1 multiplied by 100,000, or let me just, okay, 1 multiplied by 100,000, then, or let me do this one very well, so that we will not have, okay, let me come here, not 1 multiplied by 100,000. Okay, can we say that this is 4 multiplied by 25,000? Okay, multiplied by 3 cities. Can we say that the 300,000 can be calculated like that?
Yes.
Okay.
Yes, it can.
Can we also say that this can be calculated as 1 multiplied by 25,000 multiplied by 2.5?
Yes.
Okay. This and this will what? 25 and 25 will cancel, isn't it? Okay.
No.
So we can say that this can also be calculated as 4 multiplied by 3 cedi. That will give us 12. And this will give us 1 multiplied by 2.5. That will give us 2.5. So we have 5 over here, and we have 14.5. Okay. Then the theoretical extra price will give you 14.5 divided by 5. That will also give you 2.9.
2.9.
Okay. what I want to tell you is that you are not going to be calculating this on total basis. You calculate it on unit basis. Okay. So the existing shares. So what we do is that 1 for 4. We are bringing 4 of our existing shares. So 4 times the current market price, and we are taking 1. So 1 multiplied by the right issue fraction. Then we calculate that particular one. Okay. Let's assume we are doing this now. Okay. It's a very simple one. So sometimes you can calculate the right issue fraction. So the right issue fraction is calculated like this. So let's have the right issue fraction. The right issue fraction is what we call the cum X price. Okay. So the cum, let me just see the cum. Okay, the cum X price or the cum, I don't know. Okay.
Price over X price.
Okay, let me just see the market price before the right issue. Market price before the right issue divided by the theoretical XY price. Okay. So what we do is that the market price is the 3 cedi. The price before the right issue, that will be 3 cedis divided by 2.9. You'll be needing this to do some kind of adjustment. So if you want to calculate your weighted average number of shares, this is how we go about it. I will show you all the necessary method, then you pick the one that you like. Okay. So what we do is this one. Let's look at the approach 1. Okay, the one that we are all familiar with. So let's come here. When was the right issue done? July 1, isn't it? Okay, so what we do over here is that we have from January to June. Okay, from January to June, we are having what? 100,000 shares, isn't it? From January to June, we are having 100,000 shares.
Yes.
Okay. So
Yes.
you have the 100,000 shares multiplied by, because there's a bonus issue on this element, because the right issue counts with a bonus issue and a full market issue. So the bonus issue will be having effect on the existing shares. So how do we determine that bonus issue one? It will be multiplied by this particular one. So 3 over, so we have 3 multiplied by 3 over 2.9 multiplied by 6 over 12. Okay. Then you come to July to December, there will not be any issue of this again. So what you do over here is that your total number of shares from July to December will now be the existing shares plus the 25,000. So you have 125,000 multiplied by what we call the 6 over 12. Okay, so before the right issue was made, we have 100,000 shares that has been contributed, or that has contributed to the profit for what? For 6 months. But since we are making a bonus issue, the bonus issue will be having effect on the existing shares. So how do we incorporate the bonus issue element over there? We multiply this by the right issue fraction. So let's get the answers so that I will show like 3 so that you pick the one that you want. Okay. So the first one will give us 100,000.
51724.
Okay, 51724. Okay. And the last one will give us what?
62,500.
62,500. The total is what?
114,224.
114,224.
224.
Okay. So that is the first one. Let's come to the second one. They'll all be giving you the same answer. So you pick the one that you are comfortable with. Let's come here. We know that the bonus issue plus the existing shares are going to be having a full year, isn't it? The existing shares is going to be having a full year contribution. Is that correct?
Yes.
Okay. So what you do over here is that you have the existing share. So you have the existing shares. That will be January to December. That will be having a full year. Okay. So you have 100,000 multiplied by, so the bonus issue will be based on this one, 100,000 divided by 2.9 multiplied by 12 over 12. So existing share is going to be having a full year contribution. What are we getting as the answer there?
103,448.
103,448.
448.
Okay. So the existing share should have been what? 100,000, isn't it? Okay. But it is now what? 100,000, 3,400 and what?
48.
Okay. Where is the 3,448 coming from? That is a portion of the bonus issue. Okay. So that is a portion of the bonus issue. So it means that the 25,000 shares that we are issuing, 3,448 is what is a bonus issue. So what will be the remaining number of shares?
Two one five five two.
Okay. 2155 what?
552.
Okay. That is a portion that is relating to the full market issue. So the 25,000 is including bonus issue and a full market issue. And the bonus issue is the 3,448. So this will be taken out of the 25,000, which is a total issue. So we multiply this by 6 over 12. What are you getting?
10776.
Okay, 10.
776.
Okay, let's add the 2. What are we having?
114224.
114224. Okay, let's take the third one. So you select any of them, but we are all comfortable with the first one. But the first one is somehow complicated. Okay, but any of them that you are comfortable with, you pick that particular one. Okay, let's come to the third one. Okay, so let's come to the third one. The third one is this one. Let's come here. Okay, we know that the the share price of the entity is now 2.9, isn't it? Okay. If
Yes.
not for anything, the shares should be issued at 2.9. Okay. But the shares has been issued at 2.5, isn't it?
Yes.
Okay. So this 2.9 over here, 0.4 is for bonus issue, 2.5 is the bonus issue. So we now use this particular proportion to share this particular one. Okay. So let's now have the share of that. Let's have the bonus issue share of that. So let me do some small workings here. Okay. So the bonus issue element in that one. So we just separate the bonus issue from the market issue. So 0.4 divided by 2.9 multiplied by 25,000 shares. What are we having?
Three four four eight.
Okay. So we have the existing shares now. So the existing shares will now be a full year, but that will now be the bonus issue will be made on the existing shares. So that will be 3,448. Okay, so we just add the 2. That will give us the answer there. So we have 103448. Okay, let's come to the full market issue. So the full market issue. Okay, so we have 3448 as a bonus issue. What will be the full market issue? That will be 2.5 divided by 2.9 multiplied by the total number of shares. Okay, and that will be the same as the one that we have first. 2155 what? Okay, multiplied by the 6 over 12. This is a full market issue, so it will contribute to only what? Only 6 months. Okay, and that will give us 10776.
776.
So 114224. Okay, so this is 3 ways of doing this. You can pick the one that you like. Please, let's pick one question on the on the right issue, how we go about it. Okay, the right issue also we restate. Okay, why do we restate? Because the right issue is having a bonus issue element over there. Okay, so we look at how to go about that. Okay, that is not a bonus issue. Let's come to, let me just pick a question that is going to be, okay. Okay, let's come to question number 8. That is actually relating to the right issue. Let's take that one. We pick a question that they can combine at least two of them. There can be a full market value, there can be a right issue, or there can be a bonus issue in one question. So the first thing is that we have to understand them one by one. Okay, but that one we do it after we have done the diluted earnings per share. Okay, let's do the question number 8 now. Auntie Vic, are you gone or you are still there? Vic,
Don't worry, I read.
okay, sir.
Question 8. Garfish had profits after tax of 3 million in the year ended 31st December 2017. On the 1st of January 2017, Garfish had 2.4 million ordinary shares in issue. On 1st April 2017, Garfish made a 1-for-2 rights issue at a price of 1.4 cedis, when the market price of Garfish share was 2 cedis. Required, in accordance with IAS 33 earnings per share, calculate the basic and diluted earnings per share.
Okay. All right. So we can see that what would be the percentage of this particular issue? What would be the percentage? 1-for-2.
50%.
Okay. That would be 50%. Okay. This one we don't do the right issue fraction over here. We don't multiply by the right issue fraction. This is a bonus issue. This we don't multiply by the bonus issue fraction. This is a right issue rather. Okay, let's come here. So the question number 8, we have the catfish. Okay, they are asking for basic earnings per share. So the basic earnings per share, someone can also see is the profit after tax, but this profit after tax should be less what irredeemable preference shares. So divided by what we call the weighted average number of shares. Okay, so what you are going to be calculating in most cases will be the weighted average number of shares. Although the earnings, they can give you irredeemable preference shares, and you have to calculate their dividends and take it from it. Okay, but in most cases, you are going to be doing this. Before you calculate this, you need to know the value of the entity shares after the right issue. So we are going to be calculating the theoretical extra price. So let's have the existing shares. Okay, the existing shares, we are bringing 2 for 1, isn't it? So we do it on unit basis, 2 for 1. Okay. In most cases, they will not give you the total, shares, or you will not be able to get a total shares. So you just do it on a unit basis. Okay. So we are doing 1-for-2. We are bringing 2 of our existing shares. Then we are taking what? 1 what? We are bringing 2 right for what? For 1 new share. So it means that if you have 2 shares, you are qualified for a new share or a 1 new share. Okay, that is what they are saying. So what is the market price of the share before the right issue?
2 cedis.
Okay, that is 2 cedis. Okay, they will say the right issue at the market price at that date is what? Is that particular one. So multiply by 2. Our value will now be 4 cedi here, isn't it? Okay, let's come to the right issue. The right issue, we are taking 1 at what? 1 CD.
1.4.
Okay, so that will give us 1.4. Okay, our total we now have on unit basis, we'll be having 3 units against what? 5.4. Is that correct? Our theoretical XY price will now give us 5.4 divided by 3. What are we having?
1.8.
1.8.
8.
Okay, so we are having 1.8. So the share should have been issued at 1.8 so that we'll be having the same. Okay, so the share should have been issued at what? 1.8. Why are we saying 1.8? The new share should have been issued at 1.8 so that our 2 series shares will now reduce by what? By 0.2, which will be the bonus issue. Okay. Now, what is the number of shares that we are doing from the right issue? Number of shares from the right issue. Okay, or I'll use only 2 of these ones. Okay, let me come here. So let's look at the right issue fraction. Okay, the right issue fraction will be 2 CD divided by 1.8. Is that correct? Two CD divided by 1.8. The right issue fraction is the share price before the right issue divided by the theoretical XY price. So let me come to my existing shares over here, or the beginning of the year is what? Okay, it's January. They have what? 2.4 million shares. And the right issue was made on what?
1st of April.
Okay, so it means that the existing shares will be used for 3 months before what? Before the right issue. So let's have January to March. Okay, we are going to be having 2.4 million multiplied by 2 over 1.8 multiplied by 3 over 12. Is that correct? Okay, so we have April to December. So we are going to be having 2.4. That shares will be used for 3 months before we now what? We now do the right issue. So if you want to determine the right issue fraction, you apply the right, if you want to determine the weighted average number of shares, you apply the right issue fraction up to the time that the right issue is made. So we apply it for only January to March because the right issue has been made on what? On 1st April. So the bonus issue will only be on the existing shares for 3 months. Okay, let's come here. We are coming to have the total number of shares. So we have the 2.4 shares at the beginning plus what? 142, which is half. That will give us 1.2 also. And that will give us 3.6 as a total number of shares. Is that correct? It is 142. So bring 2 of your existing shares for 1. So there will be a new issue of shares that will be 1.2. Okay. So the total will now give us 3.6 million shares. Okay. Multiplied by 9 over 12. Okay. The bonus issue will not be on these ones. Okay. The bonus issue will be on the shares that we are in existence before the right issue. What are we having as our final answer here? So 3.6 multiplied by 9 over 12. I'm having 2.7 for this one.
Yes.
Okay. The first one is what?
0.6.
0.
0.6.
Okay, 0.67. So 0.67. What is the total?
3.37.
3.37.
Okay, 3.37. Okay. So that is one way. Let's go to, I'll use only 2. Okay. So let's come here. Okay. We know that our market shares should be what? Should be 1.8, but the shares has been issued at what? 1.4. There's a bonus issue of what? So you share. Okay. So that the 1.2 million shares should have been issued at 1.8, but you issued at 1.47. So it means that you are financing this one from a bonus issue. Okay, your reserves. So we have 0.4 divided by 1.8 multiplied by 1.2 million shares. What are we having? Okay, so you have the full market issue. That will give us 1.4 divided by 1.8 multiplied by the 1.2 million shares. Okay, what are we getting for the first one?
0.27.
So we have 0.27. Okay, and the second one is what?
0.93.
0.93. Okay, so this is what you do over here. So let's calculate our weighted average number of shares now. So you can do your existing shares. The bonus issue is going to be having effect on that. So our existing shares will now be the 2.4 plus the bonus issue will be made on only the existing shares. The bonus issue will be made on what? On the shares that has been in existence before the what? Before the bonus issue. So that will be made on only 2.4. The bonus issue is made on the same day the right issue is made. So there's no way the bonus issue will be having effect on a full market issue from the right issue. So we have it will be the existing shares that are going to be what? That are going to be deriving from this one. So we have 0.27. Then this will have a full year, 12 over 12. So what are we going to be having?
$2.67.
Okay, so we have 2.67. So we come to the full market issue. That will be April to December. That will be 0.93 multiplied by 9 over 12. What are we having?
Um, 0.7.
Okay, so we have 0.7. What is the total?
3.37.
Okay, 3.37. Okay, so we now come here. Our earnings for that particular period is what? Earnings is 3 million, isn't it?
Yes.
Okay. Earnings is 3 million. So we have 3 million divided by 3.37 million shares. Okay. What is the answer there?
0.89. So
Okay.
89 plus.
And that will give us 8.9 what? 89 what?
89 plus.
Okay. So that will give us 89 pesos per what? Per share. Don't do it 0.0. No. If you're having 0 point something, just change it to pesos. It should be presented in what? In a whole number. Okay. If you have, sometimes the question can give you the earnings per share for the previous year. So what you do is that you also change it to this one. Assuming you are given earnings per share, from the previous year. So this is what you do. You come and restate what the previous year. So let's see, the previous year was, let's say, 2003. Okay, let me go and check the date very well before I will take that. Okay, 2x3, that will be 2, okay, that will be 2x8. Okay, so let's see, that was 2x8. Okay, so we have 2x8 over here. We have 2x8. Let's see, the earnings per share for that particular one was actually, let's see, 70 best ways. Okay. Because there's a bonus issue, the bonus issue will be affecting the earnings per share also. How do we do it? You change the right issue fraction, the way we do the first one. So that will be 1.8 divided by 2. So 1.8 divided by 2, and that will give you your restate what? Or the restated earnings per share for the previous year. That's how we go about that one also. So this is all about the basic earnings per share, but we pick a question where they are going to be having at least two of them in one question. There can be a bonus issue and also a full market issue in one question, or there can be a full market issue and it will be followed by a bonus issue, or it can also be followed by a right issue. How do we determine the what? The weighted average number of shares? We'll do that tomorrow. So tomorrow we do diluted earnings per share. Then we pick normal exam questions and solve any issue.
No, sir.
Okay, so I will see you guys at 9 p.m., 9 a.m. Then we continue with consolidation. Thank you all for coming.